the briefing, and obviously looking at the charts this morning, risk-off sentiment materializing overnight in Asia Pacific trade. You can see center right in my charts, the S&P coming under some fairly heavy selling pressure, kicking off from around 11 o'clock last night all the way through the early part of kind of the Asia Pac session when Japan would have got underway, Australian markets and so on, after touching a low down in the S&P 2379 and a quarter. Looking at the S&P here, fairly interesting level where it initially ran to on the momentum of the selling pressure overnight. That 79 mark being also the low point that was seen back on the 11th. And so we've recovered a little bit of lost ground, but still indicative then of a gap lower in the European futures at the open. Hence you can see that in the DAX this morning. So this being the catch-up then, given Eurex trade finishing at 9 PM, reopening at 7. So you've had the gap down, had a little brief run lower, a break of the previous support from yesterday afternoon and morning. Saw a little bit of an extension at the cash equity open when the volume typically picks up. But then we've recovered quite sharply already, having moved back in towards S1. Downsides, technically though, if we were to retest the low, we're kind of right in the middle of this broader range that's been in place since really the break into it on the 5th. So we're looking at this low point, double bottom on the 11th and 8th, around the 12,667, and an upside kind of got a triple top now at 12,843.5, defining this kind of broader range of the last kind of week or so. So risk off equals then support for gold, up around $6.50 this morning. However, has found a bit of resistance around the R2 level at this present point. Obviously you can see here when the news broke, we've shot higher, that also being a kind of test of those levels that were holding up some of the price action yesterday afternoon in the US evening, around that 1238.9. But the latest Trump information by the press prompting a further flight to quality, so gold bid, and it's kind of stayed that way. We're now within that range of R1 to R2. And dollar yen has been the other one. Obviously gold strengthens in this fashion, then yen typically does so as well. And so likewise yesterday, with a bit of general bias to downside in US equities on, well, we'll talk through the kind of timeline of stories from Trump the last kind of 48 hours. But this kind of negative sentiment developing has consequently resulted in yen strength, so a pretty continued pattern lower, and then here we are now down at sub a 113 handle. Looking slightly longer time frame when we're looking at the dollar yen pair, just been looking, we're trading a 112.26. obviously you've got the 112 handle downside. Below here, worth maybe keeping an eye on 111.91. That's the kind of low that we printed, you can see there, back in early May, but then also coincides with around the high that we printed at the end of March as well. So fairly significant levels, just around 112 on the downside in dollar yen. Obviously being sensitive to any negative developments will drive that price lower. Combination of the, some of the weaker data that we've had on balance from the US, and this obviously question marks over the fiscal implementation or the delay of that occurring, given what's been unfolding with Trump last couple of days, in combination of this flight to quality boosting the yen as well. So dollar yen, pretty decent moves of late. Quick recap then of what we had with Trump. It started off with this report in the Washington Post at the weekend. It's been a bit of a pantomime show of sorts. The first headline on Sunday was Trump revealed highly classified information to Russian foreign minister and ambassador. So that was the one when we came in yesterday, and we were kind of looking at the fact that obviously this comes in the context of him firing the FBI director James Comey quite recently, and then him speaking the very next day to some high-ranking Russian officials, and then it coming to light that he's basically unveiled, apparently, detailed information on ISIS that he wouldn't have even have revealed to his closest allies, but he's told the Russians. So that was the first kind of negative development. This is then the National Security Advisor, so McMaster, who was pretty quick to come out and defend this and saying that this was not the case, this is misinformation in the press in the Washington Post. He then came out and said basically it led to Trump coming out and then tweeting yesterday afternoon, and his team around him denied the Washington Post report that he ever said such a thing. But then Trump hit Twitter and said, as president, I wanted to share with Russia at an openly scheduled White House meeting, which I have the absolute right to do so, facts pertaining to terrorism and airline flight safety, humanitarian reasons, plus I want Russia to greatly step up their fight against ISIS and terrorism. So after his team and his PR crew had done the best job they could to distance themselves from reports and deny that this conversation ever took place, Trump kind of shot himself in the foot slightly by saying, well, he did actually speak to Russia and he did talk about certain things. So this then led to McMaster had a press conference yesterday afternoon, wholly appropriate for Trump to share intelligence with Russians, but was saying it was not of a level of which was anything out of the ordinary. This has now led to the final development, which has happened overnight and has caused this latest risk aversion in the markets. And this has come as the New York Times now have reported, essentially, that President Trump asked the FBI director, Comey, to shut down the federal investigation into Trump's former National Security Advisor, Michael Flynn, in an Oval Office meeting in February, according to a memo Mr. Comey wrote shortly after the meeting. This has caused quite severe backlash from a number of politicians on Capitol Hill. The kind of where this is leading to is that many foresee this as Trump directly interfering in the course of justice, and so cries of impeachment have started to circulate, and it's really brought into quite sharp focus not just the, I guess, delaying of what we were talking about yesterday, things like the corporate tax cuts, the infrastructure plans, and so on and so forth. This kind of sideshow has become so dominant that those other things have certainly taken a back seat. Now, question marks coming over the fate of Donald Trump just as president in general. And so, hence the reason we had quite an aggressive move overnight, sell-off in equities, hence the gap lower in European stocks. Yen strength, gold boosted, fixed income higher, so all your traditional kind of flight to quality moves being seen. Bunds already up, finding some resistance at 160.86 this morning, having gapped up with the move lower in equities. T-notes also consequently up around 10 ticks. Obviously this brings about a broader prospect for what does it mean for the Fed. We've been tracking short-term interest rate futures or federal funds rates, and what was 100% almost likelihood about a week and a half ago of a Fed interest rate hike occurring in June has dropped following some fairly weak US economic data. This to also now throw into the mix has certainly seen those prospects drop to around 70%, so still priced in, but has been falling at quite a rapid pace. So Fed commentary could be quite interesting. They've kind of used that dreaded word that I know traders like Dara don't like, but transitory. They tend to look beyond certain things as just one-off events, and that the underlying economy is quite healthy. But can they continue to follow that line of communication if this situation with Trump escalates? You would think this would equate to them or tying their hands to be able to take more kind of prudent monetary tightening, so to speak. So things are fairly calm at this present point. Much of the movement happened overnight in the Asian session, and so I think that now it's more about waiting for the US to come in to see whether or not this move has any type of second wind. Keep in mind that the actual news came out late last night, so it would have been after much of the US trading community would have gone home, and so when they come in, they will be to a large degree seeing this news with fresh eyes. So there could be a possibility of this having a secondary move, so to speak. Taking a look though at some other things to be aware of from a news perspective. Obviously this is the dominating theme, but we have had some inventory data overnight for the oil traders, just to keep you informed on what's going on there. Quite interesting actually, looking at a 60-minute candlestick chart. Obviously we had a really powerful move initiated by this pop higher just after kind of 3:30. It was when the market reacted to the commitment to do whatever it takes from Saudi Arabia and Russia, them backing then the source comments that circulated last week with the extension to the existing OPEC cuts likely to be formalized on May 25th, that they'll be extended for a further 9 months, so taking it through till March of 2018. That caused a pretty dramatic rise in the short term in crude futures. However, taking a look where we are at the moment, we've had another little dip overnight, and this is coming, this was at 9:30 last night, our time, and so we've retraced pretty much a large portion of that move already. So inventory numbers, quick recap of what the stats were. You had a crude build. Remember last week we had a fairly significant drawdown, in fact one of the biggest we've had since 2016. We've now reverted back to inventory builds. Expectations were for a draw of 2.7 million. So a much more bearish headline figure than what the markets were expecting, hence the downward movement seen overnight. And we're sitting down around 36 cents this morning. Cushing was a draw of 539,000, but no expectation value, but a draw nonetheless. Gasoline was a draw and was slightly larger than expected. Distillates a build of 1.7, so a little bit mixed. Headline bearish. Cushing though was a draw, and gasoline a slightly larger draw than expected, maybe negating some of the initial downside and what was a fairly far away from consensus reading for the headline print. As per usual then, this will set the scene for the Department of Energy release, which we'll get later on this afternoon, so certainly that's something you'll need to keep a close eye on. One interesting article I did see this morning, I have sent this out to you. There's something which I've talked about in a strategy report at the beginning of the week, and this was about essentially how it's going to get more difficult for OPEC to continue to implement these production cuts if they continue to extend the duration of them being in place. A couple of points out of the article just to quickly go over, and it'll probably put it into a bit more context and may help you kind of formulate a better view, kind of medium term, of where you think oil is going. First of all is the Saudis typically boost production during the summer to maintain exports while meeting increased local demand from air conditioning. Keeping a cap on output would mean foregoing exports and the revenues that they bring. So obviously Saudi Arabia in a slightly better position fiscally maybe than some of the other OPEC nations like Nigeria, Libya, Venezuela, those types of names, but certainly they're in an unprecedented period of being under persistent pressure with these low oil prices. So again, the significantly higher temperatures increase or result in increased use of air conditioning. Very difficult then for them to follow that through in their usual process if they're to continue cutting. Iraq, which still hasn't made its full cut, plans to boost production capacity to 5 million barrels a day, which would be an increase of 6%. and this won't conflict with its commitment to freeze output, because this is all part of the kind of the amount that they still eligible that they can ramp up to the point of still meeting their quota. Now this is a key point, is that maintenance in Iraq, Kuwait and the UAE may have accounted for about 500,000 barrels a day of output halted. That's almost half of the group's total cut. Several countries basically using their maintenance as a way of keeping production down, but what will they do, or what they did was pull it forward from later on in the year. So generally speaking, there's a seasonality to the maintenance periods, and basically in order to just adhere to the cuts, all that they did was brought that maintenance period forward. So actually in net result they're not losing out on anything, because if, as intended, the cut of production was only to 6 months, i.e. expire in June, coming up in a few weeks time, then effectively all they've done is altered the kind of productivity over the course of the year. The problem being, though, is that these maintenance or refinery shutdowns and kind of fixing of facilities and so forth has now been done, which means that later on this year, any cuts for those countries like Iraq, Kuwait and UAE has to effectively be them doing actual cuts of production, not circumventing it, so to speak. This is then what's brought about the graphic here about people making comparisons about how long realistically can this high compliance rate in which we've seen, which has been nigh on 100% over the last couple of months, how long can that continue? Now, history is what people will tend to look at as a guide, and the last time we had a significant oil output cut from OPEC was back in 2008, but you can see here there was a quick response, the target and the output cut tracking each other fairly tightly, only then for the years thereafter the divergence to get ever more wider as the timeline goes on. The question mark then is that OPEC's last cut didn't last very long. Only within a year of actually cutting, they were already starting to get less compliant. So with these issues, such as some of these major producers, Iraq, Kuwait and UAE are some of the biggest, or they're certainly in the top quartile of OPEC producers, will they continue to be highly compliant? That's the big question. You've also got obviously the two members that are exempt from the cut from the last or the existing agreement, that's Libya and Nigeria. And two key interesting points here is that Libya is producing at the highest level in nearly 2 years after restarting its largest oil field, and Nigeria has just fixed a pipeline after a 1-year halt that could boost its output by 13%. So your two people as well that are exempt from any deal and have been ramping up production because of the kind of civil tension that they've been experiencing, they have now got also capacity to raise production further. What all of this means essentially, when it comes down to it, is that it's going to really test the might and will of ultimately Saudi Arabia and Russia. They are really the key ones. And when it comes down to those two specifically, what's interesting is that Saudi Arabia have actually gone over and above and cut it further than they had to need to in order to compensate for some of these other countries. How long can they continue to do this is the question. Russia haven't got anywhere near the level of which their quota should have been to do the cuts. So still, going through this explanation then does make you a little bit more mindful, I guess, long term of the fact that US output seemingly doesn't seem to be changing. We'll be watching that US output number very closely later on this afternoon when the DOE numbers come out. But that seems to be fairly one directional at the moment, i.e. going higher. And in the context then that most people's belief seems to be the consensus forming, the longer these OPEC production cuts go on for, 9 months or even beyond in future, the less compliant it will become, the less effective it will become. So i.e. if they're going to continue to manipulate the price or have power, OPEC are going to have to do more. So again, it's It's a bit of a rock and a hard place for the likes of Saudi Arabia at the moment in the current context, which makes then on balance on the fundamentals, you would say that potential for more weighted downside in the medium term, I would say. Okay, quickly then, a quick review of the calendar. Let's have a look at what's to come. And one of the interesting things here is going to be 9:30 coming up shortly. You've got UK data. And I don't really want you to focus on the claimant count and the unemployment rate. We know that the unemployment situation in the UK is fairly healthy at this present point. What is going to be really important here is the wage data out of this particular information we're going to get this morning. Now, if we look back at cable, obviously a very interesting reaction that we had yesterday to the latest CPI report. Let me just refresh your memories. You had UK inflation, after being consistent at 2.3% through the period of February-March, jumped up to 2.7. Now, this looks like a big jump, but the analyst's expectation was for 2.6. So it was only a touch above expectation, the core reading also higher. The important thing here was it was mainly due to rising airfares and electricity prices. So when you're looking at the reaction in the market, the key thing here was that we were looking at the month of April. The difference between 2016 and 2017 was the timing of the seasonal effect of Easter. Hence those airfare prices are shot higher, inflation up. That meant it wasn't wholly surprising to see such an elevated number. And what you had in the market as well yesterday was a bit of pre-positioning. If you look at when Europe came in, a bit of reaction to the Washington Post story and dollar weakness regarding Trump yesterday morning, but as well people positioning themselves for what ultimately would be a higher number. When it came out, you had that confirmation, a brief fast money move higher before then a wave of selling. Wave of selling could be explained here, and the reason why the wage data is so important this morning is because the higher inflation goes, realistically, yes, if it was to go out of control levels of 3.5–4%, the Bank of England ultimately would probably be, their hand would be forced. But at this point, we're not at that quite elevated level. But what higher inflation does mean in reality for the consumer is the fact that household incomes continue to be pressured. The difference that we're having, though, is that if you look at average earnings on a weekly basis, they are not rising at the pace of which inflation is going up. And so if anything, you're getting a divergence forming. And what that means then is that if people aren't making more money, prices of goods are going up, saving rates have been dramatically falling in the UK. That means people are going to spend less, corporations make less money, there's less demand, UK economy slows. That's how the circle kind of progresses from there on. So this wage data is really critical, because what the market will need to see is these numbers creeping up in order to negate the negative then repercussion of what a higher cost of goods means for the UK consumer and net the UK economy. So that data, again at 9:30, just to stress, the wage components are the ones you want to be looking out for with greater interest. Quick look elsewhere, you've got the Eurozone CPI coming out, but these are, as defined by the calendar, final readings, so not looking for too much market movement on the back of that. And then going into the US afternoon, it's fairly quiet, other than the fact that you've got the Department of Energy crude oil inventory numbers, and of course you're going to be looking out for anything out of Trump. One thing I think we've learned from Donald Trump, even yesterday, was that seemingly he has very thin skin. He tends to take things particularly personal and almost like he can't help himself but try to defend himself and his position on Twitter. He did that yesterday, completely contradicting his own PR team and national security advisor, which is almost led to an escalation of this problem that he's now found himself in. I would be particularly vigilant, looking out for any Trump tweets. In the context of this New York Times article, remember, equating to UK time, he tends to be very active between the times of 11 and 12, essentially when he gets up, I would imagine. So just be on guard for that as well. And then I'd say as we get in towards midday London, you need to be aware of re-evaluating as the US come in the potential for a second interpretation of this latest development on the Trump situation. Okay guys, that's your morning briefing then. Gonna leave it at that. So main data UK coming up in about half an hour's time. So have a good session, and I'll see you in the chat room. Thank you.